Everybody, we're really excited to welcome back Tom. He's been with us, I think, at least 2 times before, right? Because we love learning about taxes and accounting and real estate. So we appreciate you being here. I know you're very popular. I know you're very busy. I know you got cheer camp going on. So thank you. Let's give Tom a round.
So thank you guys for having me back. It's one of those things that talking about taxes, like, hey, get super pumped up about it. But just a little bit about me. I've been doing taxes for over 20 years. Like I had mentioned earlier, I'm actually from Southern California. So I did taxes there for 18 years before I moved out here to open up my own tax practice. Kind of gives me a unique advantage compared to a lot of my competitors, because in order to be licensed in California, you have to have a special license or you have to be an enrolled agent. You cannot be a normal CPA a lot of times, because those are usually licensed by the state. So being an enrolled agent, having separate credentials and stuff for California, I would say over half my practice is still out of California. So a lot of the people moving to the area, stuff like that, we're kind of uniquely qualified to help out with that circumstance. We ended up being voted best financial accounting business for Idaho for 3 years in a row. So we're pretty stoked on that. It started a few years ago with just me. Now I think we have 7 employees. We're expanding. We're hoping to open up a legal side so we can offer doing contracts for real estate, especially between the business owner and the client themselves, or maybe doing trusts and wills and stuff like that. So we're actively trying to train to open that up. So why I got into real estate, especially speaking about it, kind of thrown into it. So my sister is a wholesaler in Tacoma. My brother's a real estate investor in North Carolina. He has over 30 doors between southern Idaho, North Carolina, and Tennessee. So just one of those things, the baptism by fire, you got to learn, stuff like that. So I like to start out with the quote. Sorry, some of you guys have seen this already, but the quote is, "God, do we really have to listen to another presentation on taxes?" And that's from me. I'm the one that said that. So it's one of those things. I'll try and not bore you to death. Some of the stuff may hit you like, hey, I really need to know that. Some of it might be super boring. So I apologize in advance. We'll try and get through some of that. Try to do a couple of topics where a lot of clients come in and ask me about, to try and give you guys some knowledge going forward. Nope. Okay. So start out with some interesting tax facts. Al Capone was arrested. His interest on the tax that he owed was $215,000. The tax code is currently 4 million words longer than the Bible. So anyone that want to do some late night reading? And then Ireland, the first 50,000 euros from artists are tax exempt. So that way they can focus on culture and improving the area around them instead of just on paying tax. I thought that was kind of cool. Well, it's pretty touchy. So this cartoon says, I know you might not be able to read it, they tax my refund, and they absolutely will. If you file a long form tax return and you take a state income tax deduction, the federal government never got to tax that money, so once it's coming back, they'll tax it at that point. So just a fun fact that I get to talk to people about. So real estate professional is the first topic I want to talk about. The cartoon says it's a tax shelter. So real estate professionals, there's 3 focuses on why you want to be a real estate professional. A lot of people in this room may or may not qualify, and we'll go through that. So tax loss harvesting, tax shelters, and no income limit. How many of us in the room are tax professionals? Raise your hand. By the IRS definition. Real estate professionals. So I'll get into what the difference is, because some of you may qualify and you don't know, and some who think they qualify probably don't. So, a little bit, just a brief thing on how rental income works. This is a breakdown of 2 rental properties. Rental property 1, the gross income is $30,000, the net profit after expenses is $15,000, and they have a depreciation of $10,000, which means they have taxable income of $5,000. Rental property 2, same property, but the tenant skipped out on paying some, so now their income is $20,000. Same expenses of $15,000, depreciation of $10,000. Now their income is $5,000, or their income is negative $5,000. How that works for most people is that $5,000 will then offset income on the rest of the tax return. W-2 income, self-employed income, it'll deduct that. But there's some catches on that. The income, if it's passive, the income for the adjusted gross income has to be below $150,000. Otherwise, this $5,000 that's right here gets deferred, and it keeps getting pushed back and keeps getting pushed back until the income dips below 150, or you sell that property and it all comes in at one time. Dang. Okay, so real estate professional can take losses against ordinance. So again, going back to what I was saying. So real estate professionals, it wipes out what I was saying. So if you're deemed a real estate professional, you can actually, it doesn't matter your income. You can have $400,000 or $500,000 income. That passive loss can still offset that other gain. So we could use that to an advantage. Yes, sir.
Can we define real estate professional?
I will. Yes, sir.
Okay.
Yes, sir. So rental property is still cash flow positive for lenders. So going back to that last one, we have a couple of lenders in the room. So how that looks is when they look at your return, they add back depreciation and they add back amortization. So what happens is you can actually be cash flow positive, show a loss on your income, and it still qualifies you for a loan. So it's a pretty sweet deal with what you could do. So this example, $100,000, we have $500,000 loss, so then our taxable income is $9,500. But for the lenders, again, we get to add that back, so it's a nice advantage. Okay, real estate professional. So real estate professionals, just going through it again. Another example, we have $200,000 of earnings, we have $10,000 of depreciation, and we do a cost segregation, which I'll get into in a little bit, of $75,000. Our cash flow positive is $240,000, but if you look over here, our taxable income is $165,000. So let me get in, I think I have a slide about it, but I think I'm jumping a little bit ahead. So a real estate professional has to meet 3 requirements. The first one is the 50% rule, means half of their income has to be derived from real estate. So that is a handyman, that's a construction worker, that's a real estate agent, property manager, anyone directly involved in real estate. They also have to meet a 750-hour rule. The 750-hour rule is all of the hours that you do, the meeting like this counts. Anything that you do, market research counts, anything like that, 750 hours, and you can meet that rule. So that's, if this is your full-time thing or this is what you do for the majority of the year, you're going to be able to qualify. The other one, a little bit trickier, this is the one that catches everyone, is you have to have 100 hours into your own real estate, which means that you're doing property management yourself. You're taking care of that rental yourself. If you have a property manager, you have to, it's going to be a lot harder. If you pay people to come work on your property, going to be a lot harder. So make sure you track hours, such as this meeting, doing research, contacting clients, contacting lenders, doing negotiation, contacting anyone that you can about that property, and just keep track. And if you can meet those three requirements for the IRS's terms, you meet the example of a real estate professional, and then you could directly take those losses off on your personal income tax. So pretty awesome thing. So cost segregation study, I think I go through it a little bit in here. How many of you have used cost segregation studies or know what a cost segregation study is? So a couple people in the room. So basically what it is you take a rental property and you break it out into the nuts and bolts of the house. Your house is $500,000. In a normal depreciation, you would take that house over 27 and a half years. Instead, in a cost segregation study, you break it out. The HVAC is this much. The carpet is this much. The railings and the banisters are this much. The refrigerator is this much. And you go through the entire house and you label all of the assets separate. So now what happens is we have 5-year assets, we have 7-year assets, we have 15-year assets, and what it does is we take the house, and instead of depreciating over 27 and a half years, we do the rest of the house over 39 years. But what that allows us to do is it allows us to take a lot of that depreciation up front. So let's say we have a big sale and gosh, Tom, we're going to pay a ton of capital gains tax. I don't want to pay capital gains tax, but I'm really looking at buying another rental property. We did not do a 1031 exchange. It just didn't work out. Okay, well, let's look at doing a cost segregation on a new house. We take a lot of this depreciation up front. You qualify for a real estate professional. Again, you do a cost segregation study. Let's say this house in a normal market environment is the depreciation on it's going to be 10 or 15,000. Instead, we're lumping everything up front. We're taking 75,000, and when they look at it for a loan, they add back depreciation and amortization. So we're killing a lot of tax, but we're able to add that back when we look at it for loan purposes.
So, that cost seg happens on the new property you buy, not the property.
Correct. It's on the incoming property. I've had a couple of people have asked me, hey, can I do it on one that I've already had years on? I've seen a lot of court cases go super south on that. So we like to do it when it's the first year you're putting the property into place, and then we can then do a cost segregation study on that property.
Kinds of properties that you can target to maximize that cost segregation with like bonus depreciation?
So the nice part about it is, yes, so if you break it out into different sections, you can absolutely change how the depreciation structure you want. So if you can do a 179, which is accelerated depreciation, however, if you're generating a loss, you cannot do a 179. So what you can do on some of those short-term items is you could do 200 declining balance. I know you guys don't really study depreciation, but basically you're taking a lot up front and then separating it. So it's a lot of bulk up front. So it does end up helping you. But if you have a target or an asset-rich house where you do have a lot of amenities, you do have a lot of stuff, then yeah, you can accelerate a lot of that house up front for sure.
750-hour test, is that between two spouses who file jointly?
No, sir. So it's one person, one individual.
One person has to spend at least 750.
Yes, sir. And I'll talk about that a little bit more because there's a court case that I really love, and I'll talk about that in just a minute.
50, the other rule is 50% from real estate. Can one spouse who makes very little income, but 50% of their income, but claim a household real estate professional?
Yes, that's similar to what he's saying, and yes, I'm absolutely going to talk specifically about one of my clients, and I use that exactly. So I'll talk about it in a second, but since we're kind of on topic about that, the 50-hour rule, the IRS uses a firefighter as an example in a tax court case. The guy said, hey, I'm a real estate professional. I do firefighting 3 days in a row. I do real estate investing 4 days in a row. So I'm a real estate professional because more than 50% of my time is devoted to real estate. They said, no, that is a full-blown career that you have outside of real estate investing. So they wiped out the 50% rule, and he did not qualify. So I'll talk about the spouse in just a second. Code sections 469, this is where the IRS limits the losses on rental for passive, but for real estate professionals, it overrides that rule, so it's pretty awesome. And what real estate activities count? Real estate agent, broker, property management, renting, flipping, wholesaling, construction, other miscellaneous real estate activities. So if you deal with residential real estate and in any way and you can justify it, I'd say I would take the stance and put you as a real estate professional if you can meet those other hours. So a lot of the court cases, I know I'm super weird. When I have free time, I study tax court cases. It helps me out, especially in audits, because what is the IRS looking for? Why are they looking for that? So one of the things that they hound real estate professionals on, and where they always kill them, is the hours test. So let's say you came tonight and you said, hey, I was at that meeting, I networked, and it was 2 hours. The IRS agent says, was it really 2 hours? Or was it an hour and 48 minutes? How detailed is your log? It's one of those things that they don't want to see exact 15-minute increments, so the more detailed you can make that log, the better. It's one of those things that if my client's being audited, their log's not very good, we'll help you create that, make it a little bit more kosher, but it's one of those things to make sure that you log your hours, especially if you're borderline. If you're a full-blown, you know for a shadow of a doubt, you meet all these tests, it's not going to be a big deal. But if you're borderline or you think you're close, just keep the logs, just make sure, and then if something were to happen, if we're audited, then we'll go back and go through. So this court case here, 2012, the IRS ruled that traveling between places does not count as your hours test. There was a real estate professional that was trying to keep track of his hours because he worked remote, so he was traveling constantly, and they denied that for the test. Unless you can prove that it's required or there's managerial experience that you have to do that, they have this one that kind of overrides this one, but normal everyday commuting will not count. All right, so this court case, reasonable means, is interpreted broadly. So this person in this court case, they actually is kind of a wild case, but basically they were just ballpark estimating carte blanche around the thing. And they said, if you're guesstimating, that will not count. However, if it's a reasonable means of interpreting, so that means, hey, I drive to Spokane on a regular basis, I go twice a week. That mileage log would count because there's a reasonable means for that mileage log that you're constantly keeping it. So same thing with the hours test on this, that as long as it's, hey, I go to these meetings, I go every single month, that's a reasonable means instead of a ballpark, yeah, I went to 4 or 5, and didn't really keep track. They want more concrete evidence on that. This is the firefighter test that I was talking about earlier. This one is exactly what you guys started hinting at. So I have a client. He makes roughly $400,000. He's in some sort of marketing, doesn't really have to do with a whole lot of real estate. However, his wife is an amateur actress in California. She does exactly zero work. But it's one of those things that he started incorporating her, and so we made sure that she met the hours test. She started getting her real estate license. She started showing houses. She started doing some of that stuff. So the other job that she really trying to do, but she's not really achieving it, is now on the back burner, and now she can meet those 3 tests. And so them as a household at that point, she qualifies as a real estate professional, so they can then take those passive losses, offsetting that other thing. So there is some strategy, especially if there's a stay-at-home parent or something like that. You just have to make sure that they can meet those 3 tests.
Is there a specific form you track this on, or is it just an?
So the IRS, when you keep track of mileage logs, I know a lot of people will do like the apps or anything like that. It's actually pretty easy to come up with stuff as long as you're fair and reasonable with what you're doing. So if you have a wall calendar and you just write it on that every once in a while, or you have an Excel spreadsheet, or you just have something on your computer, hey, logged in and did a few things, it's pretty easy. The main thing is you have to have something. If you go into a IRS audit and you absolutely have nothing, then we're just kind of buried, and it's one of those things that.
So what I do is I take a picture of my odometer. The only thing I do is mileage. I take a picture of my odometer when I start, and I take a picture when I'm doing real estate on my personal work, and I write that on my pads.
So mileage audits are a very easy thing as far as proof when it comes to that. I think we've had about 17 or 18 mileage audits over the years, and we've had I think we've lost 1 case. And it's one of those things that we're a pretty rural area. Well, I think we can all agree to that. We could go from Bonner's Ferry to St. Mary's, especially for real estate. So it's one of those things that, given our area, we have a little bit more leeway than, let's say, we're doing the exact same thing. We're doing real estate, but we're in Spokane. Because most of the time with that, it's usually a more condensed population. You show certain areas of that, where here we're much more broad. So as long as you have something like an oil change, a car repair, something that shows the mileage between the beginning and the end of the year, and you have a reasonable mileage log that is created, met with a client on this day, showed a house this day, something reasonable that shows that, went to an open house, went to a meeting, went to that kind of stuff, that audit will be slam dunk for the mileage though.
My wife is a real estate professional in our family, exactly that comment is. And she just keeps her, old school paper calendar, and she'll write down if she's got a meeting or she goes to something. And then we, at the end of the month, we take all that and we put it in an Excel spreadsheet. And we classify whether that's the 750 or if it also is part of the material effect. And then we take all of the emails she does in the year, and we save those off into a separate file and put that in digitally. So when IRS agent comes to me, he's going to get about 10,000 pages, which is an Excel spreadsheet up top, and every email my wife has ever sent this real estate. And we've never been audited, but every tax lawyer ever talked to me, yeah, they're going to go about 3 pages deep and be okay.
Yeah, that's the same thing what we do with our audits is I try and overwhelm the IRS agent with information. So like if one of my clients was audited, basically what we would do is say, this is what the bank statements and the credit card statements show. This is exactly what the receipts can prove. This is what we claimed on the tax return. And I'll actually Z-tape every single item on that whole return, mark all 3. This is the difference of all that kind of stuff. And then I give it to them. Have I had an IRS agent spot check that and audit the zero tape I've done? I've never had that, because once I've done all the legwork and all that kind of stuff and they can actually see what those totals are, we've had really good success on that.
And we pay for managers for all properties because we've done them here locally. Well, the ones that aren't here locally, we pay. But my wife has them send every new applicant the application. She spends 2 hours looking at every application and log that time. So if she gets 30 applications for a single turnover, that's 60 of the 100 hours done in a single file.
Yep. And like I said, it's not impossible if you have a property manager to do it. It's just more difficult. But that's a great way to do it. So I figure this is all you guys right now with tax court cases and stuff like that. So
Sorry.
yeah.
Two of my neighbors recently asked me, they're building short-term rentals right next to me. They asked me to be the housekeeper to turn over the short-term rentals for them. Does that count towards the hours as property management or no?
So house cleaning, I would probably say no. I think that would probably be pushing it. I'd have to do some court case to see if anyone's ever been audited, or what happens is somebody audits, they lose the audit, and then they appeal it, and it goes to tax court, and then that tax court makes a ruling on it. And without doing research, I would probably say you wouldn't qualify, but it'd be worth looking at. Yeah, it'd be worth looking at for sure. Let me just skip a little bit ahead. So this is Will Rogers. He says the difference between death and taxes is death doesn't get worse when Congress meets. So we kind of started talking about this already. This is the IRS guidelines for cost segregation studies and how that works. This kind of came about. This is a famous court case that involved FedEx. So basically what the IRS stances were is the engines were going out on the airplanes. And so FedEx said that that's a separate asset from the rest of the plane. And so they wanted to depreciate it and keep that track separate from the whole plane itself. And the IRS said, nope, that's one plane. So if you replace the engine on that, you have to do the same amount of depreciation as it is for the whole rest of the plane. That went to tax court, and they said, no, you can separate the assets with inside that airplane. And so that opened the door for cost segregation studies even more, so then we can break down the houses and everything else. So self-directed IRAs, this is a topic that a lot of people come in and talk about. I am not licensed investment advisor, so you would have to seek a professional, but this comes up a lot of times in my office, so I figured I'd touch a little bit about it. So what is a self-directed IRA? A self-directed IRA is a type of individual retirement account that can hold various alternative investments normally prohibited with regular IRAs. That's just a fancy way of saying you can put whatever you want in it. So you can put collectibles, you can put artwork, you can put precious metals. A lot of times, a lot of people right now are putting Bitcoin. A lot of people want to do cryptocurrency. They can't go to Edward Jones, Charles Schwab. They can't put crypto into their retirement. That's deemed too risky, so they set up what's called a self-directed IRA. So one awesome thing about self-directed IRAs is you can put real estate into it. There's a lot of catches when it comes to that, but my brother is a great example. He, about 15 years ago, decided, I hate the stock market. I lost a ton of money. What I'd like to do is I'd like to liquidate all of my retirement and put it into real estate. It's done really well for him. However, at that time, if I would have known about self-directed IRAs, he could have rolled over those retirement accounts and bought real estate with inside of his retirement account. So pretty sweet deal when it comes to that. So how it works, the real estate, you can't touch it, you can't look at it, you can't, I'm just kidding, but literally you have to be completely removed from it. So you can't do the repairs on it, you can't do the maintenance on it, you have to have a property manager on it. If it's a vacation rental, you may never rent out that vacation rental. You cannot ever use it as your own personal thing.
You said you can't rent it out. Because they can't ever use it.
So you, as owner of that, cannot rent out that unit. Yeah, you can't benefit from it at all. So, yep, just buying it strictly as an investment inside that. So you personally don't own that property. What happens is the custodian of that IRA will set up an LLC inside of your retirement account. And then that LLC will then own that property inside that retirement account. And again, it'll charge rent, it'll do all of those things. The house will appreciate in value. So it's a really good tool if you're looking at that, but you can't personally benefit from it at all. So other things that are pretty cool about that. So if you, let's say you're selling a rental property and you want to buy another rental property, you do a 1031 exchange, or you do pay the capital gains taxes. This works just like a stock inside of your retirement account. So if you sell a house that you bought for $300,000, you sell it for $500,000, you don't pay any tax on that gain. It is deferred, just like it is when you have a traditional IRA and a stock. It only comes, the money is only taxable to you once you start drawing on the money, just like a traditional IRA.
One question on that, can you do that as a Roth IRA?
Yeah. So I believe so. I have not personally had any clients do that, but I don't see why there'd be any differences in the rules on that. Again, the people that specialize in this, I don't know. Do you know any local ones here that do any?
I use self-directed or directed IRA, directedira.com. They're out of Utah. Mark Kohler, who's one of the biggest CPA and lawyers in the country, who runs it.
So a lot of my clients go out of a company out of Arizona that they do that, and I'm sure that they have the same thing, but for a Roth. Yes, sir. So pitfalls and cons for this. So RMDs are still required, which means that once you turn 73, you still have to take money out of that account. So if all of your money is sitting in a property and you don't have any cash in that, it could be pretty hard to meet those RMD requirements. Funds are not liquid. We talked about earlier how long it takes to sell a house. So if you need funds fast, you're in the real estate market. So you can't just sell a stock, a transaction, you pull out the money the next day. Nope, doesn't work like that. It's still a house. Deductions and property taxes and expenses are not deductible. They will be transacted inside the retirement account, but you personally can't take any expenditures for that on your tax returns. Higher management costs, the custodian specializes in this, usually charges a higher fee to do that. These two on the side, maintenance expenses can drain your account. So what that basically, what we're talking about here is, let's say you don't have, let's say the air conditioning breaks on the house, there's no money in the account, and you have to put in $12,000 into this account to cover the HVAC or the roof. Those monies that you put into that retirement account are considered contributions. So what happens a lot of times, people won't have enough cash value in there. There's a catastrophic event in the house. They have to put more money into the thing. And now all of a sudden you exceeded the amount for the retirement, and now you're paying 6% on the over contribution in that. So very careful with the money that you have in there, make sure you have cash value in there as well, so you don't get hosed on that. Oh, this one is huge. So what happens is, we talked about it earlier, you can't use it for personal gain, personal use. What happens is, if the IRS catches that you are using that, or you are property manager, or you have hand-to-hand contact with that house, they can make it all taxable at one time. Let's say you were 58 years old. Now you're getting hit with a 10% penalty for early withdrawal. You're getting a 1% for the state, and that whole asset is now out of your retirement, and it's all taxable at one time. So again, couple of pitfalls on that, but it's a great way if you're looking at real estate, you're looking at doing retirement, you hate the market, or you just want to change and you want to do something. It's a great way, because as we all know, and we're in this room for real estate, it appreciates in value and stuff like that. So that's it for me, guys. Does anyone have any questions or anything? Yes, sir.
I was thinking about changing my LLC to a C corp, and I want to know if that's going to affect my business credit, and if I'm able to pull out loans through the business. Does it reset my 2 years or 3 year requirement, and for doing loans through the business?
So usually during a restructure of a business, it does not affect business credit. You would have to write an explanation. They'd have to see the minutes. Most lenders would ask why you're doing it, but most of the time you're still that same entity for the federal. You still have the same EIN. You still have all of that stuff. Yeah, if you were to completely restructure where you close that down and reopen up, but just doing the 89, I don't even remember the form off the top of my head, but the C Corp election form, you just fill that out. You have to have it for, depending on what conversion you're doing, either 2 years or 5 years. But once you do that conversion, you're still the same entities, should still have the same, same everything on that. Any other questions, anybody? All right, thanks, guys.
Thanks, Tom, for inviting us.